I think that broadly, the markets are fine with an outcome where trade continues to be a bit of a struggle. But in the near term, for sure, we need some sort of a détente at a minimum. I think the direction of travel, the bias is higher. So this is not one of those situations where you need to really exceed expectations of some sort of a 3-month or 6-month period of negotiation.
No, but if you walk out and there is acrimony in the relationship between China and the United States, what does that mean?
The immediate reaction will clearly be lower. But I think where I'm going with this is that globalization is already in reverse. Some of the things that Kashkari talked about a little bit earlier about real rates being pressured lower by demographics and by these things. This whole, business is going to China to exploit cheap labor. That cheap labor supply is gone. And so the whole corporate America was already moving towards not onsourcing or onshoring, but for excess capacity, developing it here. And so in essence, what I'm arguing is that trade and politics are lagging the core economics, and that the model where businesses produce in the U.S. to sell in the U.S. was already well underway. And so I think that trade deals themselves really overstate are overstated in terms of investor expectations, and that I don't view it as wildly disruptive to the economy.
You don't think tariffs being raised to 25% on Chinese goods and being extended to the entire $550 billion worth of goods would have an impact here on the U.S. economy?
It'll have an impact, but I think it'll be a fairly small impact. It is not going to be as disruptive as you'd be led to believe by, near-term market reaction.
Mike, what do you think?
Yeah, I agree that expectations are low for anything substantive necessarily coming out of this weekend. I do think the reaction next week is going to be a bit of just a Rorschach test, right? If the market, they will almost certainly, unless there is an escalation of tensions, be an excuse on Monday to celebrate something,
up,
right? If the market doesn't do that, maybe it says more about where the market's at than what actually happened over the weekend. So that's kind of how I'm thinking about it. I think Powell was the same thing. A relatively subtle change by Powell. You rip higher by 2.5%. That showed you the market wanted to kind of get there.
But I think it also shows you, like, the worst case scenarios maybe moved off the table.
That's right.
Maybe that's what's been overwhelming.
I think the market wants this event in the rearview mirror, without a doubt. And I think really also tell me what's going to happen to the dollar and tell me if it raises or lowers the chances of China having a hard landing. That's what's going to matter to the markets here. Not so much, are we going to have to tweak industrial earnings for 2019 down a little bit because of tariffs.
Well, but if you remove these two kind of headwinds, I feel like it gives the market a chance to focus on earnings once again and PE ratios. And watching what's happened over the last 2 months, maybe that gives you...
That's the question, right? Because the market is marginally higher year to date when earnings went up 20-something%, right? So you're looking ahead into that decelerating to some number below 10. And that's the game we're at right now. Also, Apple can't get out of its own way. I hate to bring it just to individual stocks, but Goldman Sachs and Apple sometimes hold the market captive for a couple hours at a time. So whatever else was going to happen, I think positioning is defensive enough. Yesterday, we kind of held that one-day rally, which is interesting, but we had 2% one-day gains in the last 2 months that fell apart, in the next 2 weeks. So.
Yeah. I don't know if you want to dig down to individual stocks, but Apple, technology, the FANG stocks, what do you think about any of those, Barry?
I would say that there is a sort of a broader movement away from the winner-take-most companies that, the Fed sort of rang the bell on this at Jackson Hole this year about writing about how these companies were making monetary policy more difficult to implement and all, and you can already see some of the market share starting to erode. Look at the retailers, for example. This year, Target's comps 3 years ago were 1%. A year ago, everyone was writing off bricks and mortar, and they've now come up with their own internet strategy, and so they're fighting back. And so I think that this dominance of the big companies is already starting to erode a little bit, and the market sniffed that out.
Because you're considering Target a small company at this point?
My point would be Amazon
It's not Amazon or Walmart.
dominating retail, or Google completely dominating advertising.
But the problem is it's not going to be an easy path, even for guys like Target who have done so much with this to this point. Walmart, I think, has already gotten over that hump, but Target's investors are now realizing that it's expensive to do all this internet stuff and have delivery when you want it, where you want it.
Absolutely, no doubt about it. Where I was going more broadly with that, though, is in Greenspan's latest book, he talks a lot about creative destruction and how, you know, we've had this dynamism that seems to be ebbing, this business cycle. A lot of what's happened this year is showing much greater dynamism. There's much more turnover in the labor market. I talked about that last time I was on. Small business sector is really creating jobs and starting new businesses to a much greater extent than was true. And some of these winner-take-most dominant companies are starting to give way to companies, smaller companies coming up and challenging them. And that's a good thing. More competition means more pricing power, greater wage gains, all sorts of benefits from that. So I think the market sniffed that out a little bit. A point I'd also like to make, though, with respect to the underlying fundamentals that's underappreciated, and this speaks to, Joe, the discussion that you had with John Taylor and Rick Reeder the other day, is that the mix of growth matters a lot, right? So housing is slowed. We know autos have slowed because of higher interest rates. Capital investment is still booming. I know Andrew likes to take the government at their word, but I was in last time and I said, no, it really didn't slow much in the third quarter. It was revised up in this week's GDP, but the bottoms-up capital investment numbers, S&P 500 were up 16% in the third quarter. Government's going to revise up their numbers further. Capital investment is booming. If capital investment is driving growth, that's not inflationary. That makes productivity go higher.
That's true.
Clarida talked about that this week. That is a much better mix of growth than just driving up growth through residential investment or consumption.